The learning objectives are: 1. Identify the uses and users of accounting. 2. Describe the primary forms of business organization. 3. Explain the three main types of business activity. And last but not least, describe the purpose and content of each of the financial statements. Let's first discuss accounting. So what is accounting? Accounting is the information system that identifies and records the economic events of an organization and then communicates them to a wide variety of interested users. So, what are economic events? Economic events are an exchange of goods for money. For example, if you wish to purchase a bag at a store, when you go to the counter to pay for it, you are exchanging your money for that bag. So it is an exchange of goods for money. Users of accounting information can be divided into two types: internal users and external users. Internal users of accounting information manage companies, nonprofits, and government organizations. They also work for and manage these organizations. Internal users have access to internal accounting information to help them make the decisions required to run the company. These include company officers as well as managers and directors in finance, marketing, human resources, production, and other functional areas within a company. External users are not involved in managing a company and do not have access to accounting information other than that which is available to the general public. Types of external users of accounting information includes investors, lenders, and creditors. Investors use accounting information to make decisions to buy, hold, or sell their ownership interest. Lenders, such as bankers, use accounting information to evaluate the risk of lending money. Creditors, such as suppliers, use accounting information to decide whether or not to grant credit to a customer. Therefore, investors, lenders, and other creditors are considered to be the primary users of accounting information. In addition to investors, lenders, and other creditors, other external users include customers, employees, and labor unions. Current employees who are not directly involved in managing the company, as well as any labor union that may represent them. Taxing authorities, such as Canada Revenue Agency, use information from a company's financial statements in assessing a company's income tax return. Ethical behavior. For financial information to have value to its users, whether internal or external, it must be prepared by individuals with high standards of ethical behavior. This is because we are looking at the financial statements and expecting to use it to make our financial decisions. Fortunately, most individuals in business are ethical. Their actions are both legal and responsible. Accountants and other professionals have extensive rules of professional conduct to guide their behavior with each other and the public. In addition, most companies have codes of conduct that outline their commitment to ethical behavior in their internal and external relationships. Let us also consider examples of unethical behaviors. These may include exploiting workers, overbilling customers, creating fake identities, theft, and other unlawful conduct. So these are forms of business organizations. We'll first look at proprietorship. Proprietorship is a business owned by one person, known as a proprietor. It is often called a sole proprietorship because there is a single owner. The proprietorship form of business organization is simple to set up and gives the owner control over the business. In most cases, only a relatively small amount of money or capital is needed to start in business as a proprietorship. The owner receives any income, suffers any losses, and is personally responsible for all debts of the business. This is known as unlimited liability. The income tax is also paid by the owner. So whatever money is made, it has to be reported on the proprietorship personal income tax return as business income. Examples of proprietorships may include small service businesses such as hair salons, plumbers, carpenters, and mechanics. Let's have a look at the next form of business organization, partnership. A partnership is a business owned by more than one person. In most cases, a partnership is like a proprietorship, except that there is more than one owner. Partnerships are often formed because one person does not have enough economic resources to start or expand the business, or because partners bring unique skills and resources to the partnership. Partnerships are normally formalized in a written partnership agreement that outlines the formation of the partnerships, partners' contributions, and how net income and losses are shared. Limited life. What does that mean? This means that if one partner dies, then the partnership may cease to exist. Also, each partner generally has unlimited liability for all debts of the partnership, even if one of the other partners created the debt. Therefore, you can get sued, say if your partner does something unethical, even if you were not aware of it. Examples of partnerships may include professional practices such as practice of lawyers, doctors, architects, engineers, and accountants. Corporation. A corporation is a business organized as a separate legal entity owned by its shareholders. It is the most complex form of business to establish. Examples may include like WestJet, Air Canada, Microsoft, Apple Computers, to name a few. Indefinite life. This means that the corporation still goes on if someone dies. For example, Steve Jobs from Apple Computers died, and the company is still going on. Ease of raising capital. It is easier for corporations, especially large corporations, to raise capital or cash compared with proprietorships and partnerships. For example, if you're Amazon or Best Buy, then it will be much easier to get money as you have established yourself as a successful company. Also, shareholders enjoy limited liability. This means that their risk of loss is limited to the amount that they have invested in the company shares. Corporation pays also income tax. Another advantage corporation has is that they may have a favorable income tax treatment other than other forms of business organizations such as proprietorships and partnerships because of the wide variety of income tax issues that apply to different companies in different jurisdictions. They may be public or private. Public means that the shares are available to be sold on the stock market, while private means it is not available to the general public. All companies that are public started out as private. For example, Facebook, Apple, and Microsoft. Generally accepted accounting principles, otherwise known as GAAP. How do businesses decide on the amount of financial information to disclose? And in what format should financial information be presented? These rules and practices are referred to as generally accepted accounting principles. GAAP includes broad policies and practices, as well as rules and procedures that have authoritative support and agreement about how to record and report economic events. These are the rules and practices that you have to go by. So, for example, if you are an engineer or a doctor, there are certain rules that you must follow. Generally accepted accounting principles can differ depending on the form of business organization. Publicly traded corporations must use International Financial Reporting Standards, which are a set of all businesses are involved in three types of activity: financing, investing, and operating. Each of these activities can result in inflows of cash or outflows of cash. Financing activities. Money is required to start any business. The two primary ways of raising outside funds for corporations are issuing or selling shares in exchange for cash and borrowing money. When you borrow money from the bank, you are creating debt. There are different forms of debt. When a company uses operating line of credit to cover cash shortfalls and overdraws its bank account, it is called a bank indebtedness. Corporations may borrow using a short-term bank loan payable or use long-term debt. Long-term debt includes mortgages, payables, bonds payable, and finance lease obligations. Investing activities. Investing activities involve the purchase or sale of long-lived assets that a company needs in order to function. Assets are resources that a company owns or controls. Long-lived assets is anything purchased to be used for greater than 1 year. For example, buildings, equipment, computers, vehicles, and land. Together, these assets are referred to as property, plant, and equipment. So, what's the difference between tangible and intangible assets? Tangible assets are things that you can see or touch. Examples are building, while intangible assets does not have any physical substance themselves, but represent a privilege or a right granted. Examples of intangible assets include copyrights, trademarks, and goodwill. Companies can also have investing activities related to the purchase or sale of shares or debt securities of other companies. Operating activities relates to what a company does on a day-to-day basis. It includes revenues and expenses, changes in related accounts, including receivables, inventory, supplies, and payables accounts. Remember also that revenue is the same thing as income. So let's look at the meanings of some of these examples. So supplies, examples of supplies include like office and cleaning supplies. Inventory, these are items that are held for future sale to customers. And accounts payable is an obligation to pay for goods that you have already purchased on credit. Financial statements. There are 4 types of financial statements. First is the income statement, and this reports revenues and expenses for a specific period of time. Second, statement of changes in equity. This reports changes in each component of shareholders' equity during a period of time. Third, statement of financial position. This is also referred to as the balance sheet. shows the assets, liabilities, and shareholders' equity at a specific point in time. Statement of cash flows. This shows for a specific period of time how company obtained cash and how cash was used. So the order of preparation of statements is income statement first, then statement of changes in equity, third, statement of financial position, and the fourth is statement of cash flows. Income statement. So what is on the income statement? So it records our revenues and our expenses. And our revenues actually comes from sales of a product or services and also results in an inflow of assets. Some examples of expenses may include salaries, utilities, equipment, rent. So these are all expenses. So when we take our revenues minus our expenses, we get what is called net income or net loss. This is an example of the income statement of Sierra Corporation. It starts off with the revenues. We see service revenue of $20,600. Then we list our expenses, and these include salaries expense, supplies, rent expense, depreciation, insurance, and interest expense. The total for our expenses are $7,758. So we subtract that figure from our revenues of $20,600, which gives us $12,842. That is called income before income tax. Then we less our income tax expense of $1,800 from the income before income tax, and that gives us a net income of $11,042. Keep this number in mind, as the statements are all linked. Statement of changes in equity shows the changes in total shareholders' equity for the period as well as the changes in each component of shareholders' equity during the period. Share capital. So this represents amount contributed by the shareholders in exchange for shares of ownership. Most companies have two types of shares. There are common and preferred shares. Common shareholders get a vote at an annual general meeting, while preferred shareholders has no voting rights. The second category are retained earnings. Retained earnings are cumulative net income retained in the company. Cumulative basically means added to the last results. So as an example of cumulative, let's say we started our business on January 1st. We make a net income of say $10,000 at the end of January. Then February comes along and we make a net income of another $10,000. So the cumulative amount is $10,000 in January and $10,000 in February, which totals $20,000. Then less dividends paid. So a dividend is a return of profits to its shareholders. The statement of changes in equity shows the changes in total shareholders' equity for the period, as well as the changes in each component of shareholders' equity during the period. It starts with the account balances at the beginning of the period and ends with the account balance at the end of the period. Changes in retained earnings. So here we have revenues minus expenses. That's equal to our net income or net loss. So the column for retained earnings starts with the beginning balance of retained earnings. The net income for the period is then added, and then dividends declared is deducted from the beginning to calculate the retained earnings at the end of the period as well. So this example shows the statement of changes in equity starts with the beginning balance of share capital, which is common shares in Sierra's case. This is 0, Coursera because it just began operations at the beginning of the month, which is October 1st. The statement then goes on to add any changes in share capital due to new shares issued during the period to arrive at the ending balance of share capital, as shown in the equation format here. So this is a statement of financial position. Shows assets, and assets are things that we own, OWN. And these are resources owned or controlled by a business. Then there's liabilities, which are things that we owe, OWE, and this includes claims of lenders and other creditors. Shareholders' equity are also things that we owe. These are claims of shareholders as well. So then we have our accounting equation, which is very important. This is assets equal liabilities plus shareholders' equity. So let us now look at an example of the statement of financial position. So this slide shows an example of statement of financial position. So at Coursera Corporation as at October 31st, 2018. We start off with our assets, and in chronological order, we have our cash of $11,400, accounts receivable, supplies, prepaid insurance, equipment, and our total assets in this case is $29,067. Here we have our liabilities and shareholders' equity. Our liabilities includes accounts payable, salaries payable, interest payable, unearned revenue, and bank loan payable. Our total liabilities is $8,525. Then we have shareholders' equity, which includes common shares of $10,000 and retained earnings of $10,542. Our total shareholders' equity is $20,542. So then we total our liabilities and shareholders' equity, which gives us $29,067. So this is our statement of cash flows. The main function of a statement of cash flow is to provide financial information about the cash receipts and cash payments of a business for a specific period of time. It is to help investors, lenders, and other creditors, and others in their analysis of a company's cash position. The statement of cash flows reports the effects on cash of companies. 1. Their operating activities, investing activities, and their financing activities during the period of time. Investing activities involve the purchase or sale of long-lived resources, such as property, plant, and equipment that a company needs to operate, and the purchase or sale of investments in long-term securities. Financing activities involve borrowing long-term debt from our lenders and issuing shares and distributing dividends to shareholders. Then our operating activities are normally presented first in the statement of cash flows, followed by investing and financing activities. In this example, Sarah's statement of cash flows shows that overall cash increased by $11,400 during the month. Operating activities generated $1,900 in cash during the month, but this was not enough cash to fund the investing activities of $5,000 during the month. So, to help offset the shortfall, the company was able to generate $14,500 in cash from its financing activities. As a result, the company's cash inflows for the period exceeded its outflows, resulting in a net increase of $11,400. Relationships between statements. So all statements are interrelated. The results from some statements are used as data in other statements. Examples of these: Net income from income statement is reported in statement of changes in equity. Also, the ending balances of each shareholder's equity account is reported in both statements of financial position and changes in equity, as well as the statement of cash flows is related to statement of financial position, otherwise known as balance sheet.